So how will this latest interest rate rise impact on mainstream Australia? The Housing Industry Association says today's rise will, quote, see more than 650,000 Australian households caught in the grip of mortgage stress. Dr. Steve Keen is an academic economist at the University of Western Sydney who has done substantial research on Australia's debt levels, both household and business debt, with a monthly report called Debt Watch. He joins me now. Steve Keen, how will this rate rise impact on various mortgage-belt households around Australia?
Well, it is going to make what looks like a fairly minor increase in the amount of money that has to come out of the household budget to pay the new level of average mortgage payments, just in terms of the interest payments that are made on the mortgages. It's going to go from 11.4 cents in the household dollar just to pay the interest on mortgages to 11.7. Now, that doesn't look like very much, but if you go back in history and take a longer view and say, what was it like back 30 years ago in 1977, it was 2 cents in the dollar. So we're talking virtually 6 times as much. If you go back to 1990, which is when we had those, of course, astronomically high nominal interest rates, it was 4.5 cents in the dollar. So even though we've got a substantially lower rate of interest now, it's almost 3 times as much coming out of the household budget to cover interest payments. And just since the 2004 election, we've gone from 8 cents in the dollar to now about 11.7. So almost 50% higher again than during the 2004 election.
Before we look at speculate on the potential impact of this latest rise, how clear is the evidence that the rising interest rate environment is forcing some people to sell their homes?
Very high, and it's been disguised by the official figures as well. At the parliamentary hearing, which the Economics Committee held about 2 or 3 months ago, one of the mortgage insurers commented there that mortgagees don't like to have mortgagee sales because they face about a 15 to 20% hit in the price they're going to get in the market. So they actually pressure the people who have got into distress to sell before it gets to the stage of a default. Now, even with that, the level of defaults has risen by at least 40% over the figures at the same time as last year. So it's a very rapid increase in defaults when, again, we know they don't really tell us how bad the story is.
So what is the picture now with rental accommodation, and what is the likely impact of this next rise?
That is almost where you've got to say who's writing the script here, Joseph Heller, you know, where is Yossarian? Because at the same time as we had what people called a housing boom, if you take a careful look at what actually happened, we didn't really build all that many houses. Over 90% of the money that was borrowed during that so-called housing boom was used to buy existing properties. Less than 10% went to build new accommodation. That's why we got to the end of this so-called housing boom and found ourselves with a rental crisis almost before we could blink. America, on the other hand, did build large numbers of houses, and they now have a glut. So we've got the ironic situation of having house prices that are too high for people to afford, and simultaneously a shortage of rental accommodation for people who can't afford to buy a house, which is driving up rents. And to me, that's the real irony with this latest interest rate rise. The Reserve Bank sees increasing interest rates as a way of controlling inflation, but in fact the biggest contributor to inflation in the last set of figures was the increase in rental costs, which was 5.8% over the year. So it's catch-22. We're putting up interest rates to control something that's going to become more expensive.
But that will be exacerbated again.
I think so, because, again, taking a look at breaking down carefully where the rises were and where the falls were, there were a substantial number of classifications in the CPI that actually fell over the last year. I think the most was furniture, which fell by more than 1%. But the biggest rises were all in what are known as the FIRE economy, which is finance, insurance and real estate. Now, those are all segments of the economy where if you drive up interest rates, you're likely to cause more inflationary pressure.
So what's been the cumulative effect on house prices in the big cities like Sydney and Melbourne after the first interest rate rises since the last election? That's the first 5. And what's likely to happen on the residential market after this rise?
In terms of prices?
In terms of value of housing, yes,
well,
house prices.
Value of housing over when you start to define the latest boom, which began about 94, house values have increased by about 250% over that period of time. At the same time, debt has increased about 600%. Now, the prices have been driven up because people are willing to borrow more money than you did to buy the place in the first instance. What happens actually is debt rises faster than prices. I think this latest rise is likely to be a sting in the tail, because you get to a certain point where people look at the price rise and think, can I believe there'll be another price rise again that means somebody that will borrow more money than I did to buy this place off me in 2 or 3 years' time? I think this might be the one that breaks the camel's back and people lose that expectation, and then we will see prices falling here as we have seen in America.
Wages, when you talk about comparisons with time past and today, interest rates may have gone up, but of course wages have risen as well, haven't they?
Not as much. So this is, again, when you take a look at the comparisons of the real increase in wages, yes, there has been a substantial rise in real wages in the last 17 years since the depths of the 1990s recession. So if you go back to the 1990s recession and compare real wages now to real wages, then you see they've risen by about 25%, which is quite substantial. But across the same time period, the real interest burden has gone up by over 250%, more than 10 times as much. Even if you look at the last election, since the last election, real wages have risen by about 5%, which is a significant achievement. But across that same time period, the real interest rate burden that households are facing has gone up by almost 50%. So interest rates are cutting more and more into the cost of living, which is why people are not feeling that they're better off than they've ever been before.
Now, you've expressed concern a number of times about the growth of debt in Australia. Where does household debt sit today compared to the past? Well,
household debt back in 1977, for example, was equivalent to about 18% of household disposable income. So let's say if you take round figures and say you had a disposable income of $100,000, you'd owe $18,000 in a mortgage. Now you come forward to today, and if you have a disposable income of $100,000, again, I know that's high, but let's take a round number, you owe $137,000. So we've gone from a tiny fraction, really, of your income being your debt to more than you earn on an annual basis on the average. And of course, a large number of households don't have debt, so that's much more focused on those who are in mortgage stress.
But I heard the point put to Peter Costello, the Treasurer, tonight on ABC Radio about household debt. And he said that you don't just look at debt, you look at assets. And while people's debt may have risen, so in many cases is the value of their assets, in particular the family home.
Assets, I think the first three words of that, three letters of that word are quite important, because the way we measure assets is nowhere near as real as the way we measure debt. If I say I've got a debt of $100,000, I owe somebody something that gives me a permanent commitment to pay based on that $100,000. If I say my house is worth $500,000, I have to find somebody who's willing to buy it. Now, the asset market is nowhere near as broad as the market for goods and so on. So those prices are all imputed, and it's quite possible that those prices won't be realised when you actually have to sell. And certainly that's what's happening to a large number of Americans now. And it simply is not possible to have asset prices rising forever faster than consumer prices. And America's learning that lesson. I think we're going to learn it somewhat later.
Some economists are expecting yet another rate rise in the not-too-distant future. The Reserve Bank is trying to do its job under the Charter, keeping inflation in check in the face of Australia's biggest ever resources boom. Surely the Reserve can only do what its Charter instructs it to do, and that is keep inflation to 3% or less.
That's its compact with the government. It also has the Charter that says it has to both maintain low inflation and full employment. And it's making judgments about the importance of inflation in limiting the extent to which we can have a rise in unemployment. Now, I'm afraid that we're making decisions based on 40 or 50 years when we've in fact been in a debt bubble that goes back right to the 1960s. And we have driven levels of debt so high that we are now experiencing twice as much debt as caused the Great Depression. Now, in that situation...
But you can't immediately draw the analogy that means there's a depression lurking.
No, I don't. But what I do say is that we have to look very carefully at inflation now. Inflation was the scourge of the 1970s. Deflation was the scourge of the 1930s. Inflation now is quite low on historic terms. Debt is astronomical. I would rather say let's pay a bit more attention to debt and worry less about inflation now, because we may actually want inflation. I'm not saying we will get into the situation that Japan was in 1990, but Japan entered a debt deflation in 1990 and is stuck there for 15 years, and the Reserve Bank of Japan spent 15 years trying to cause inflation, and they failed abjectly.
Steve Keen, we're out of time, but thanks for talking with us.
Thank you.